Hello, good afternoon, and welcome to this NQA webinar, ISO 27001 Risk Assessments Explained. If everyone can hear me okay, just give me a little note in the questions box and we'll get going. Brilliant, thank you Alex, thank you Kelvin, thank you Julie, thank you for that. We'll make a start. So as with all the webinars, we'll have a kind of Q&A session at the end. So if you have got any questions, please feel free to keep hold of them till the end of the webinar, and then we'll have a bit of time set aside to go through any questions that you may have thought of during the webinar. So a little bit about NQA. Obviously, we're a global company, offices around the globe. Been in business now for just over 30 years. We've got about 10,000 employees worldwide, and we hand out around 36,000 certificates globally. That number's actually risen to over about 40. So NQA's price promise here, we're rolling charges basically. So the price you get quoted for our services is a price you'll pay. There's no hidden extras, and there's just a kind of example of some of the customers that we've been working with for quite some time. So down to today's order of business then. So yeah, we're here today to kind of look at one of the most important parts of the 27001 certification process. That's the risk assessment itself. So we're going to be looking at the information security risk management methodologies. So these are the rules for conducting a risk assessment. Now these are your rules, the rules within your business, which obviously can differ from industry to industry and sector to sector. So what we talk about today is a very generic overall methodology. You just need to adapt them to suit your business. We're going to talk about the identification of information security risks, what kind of things are threats or what can be classed as threats. We're talking about performing the actual information security risk assessments themselves, what to consider when you perform your risk, what kind of things you want to look at. And also as well, we're going to look at the treatment of information security risk. So what to do to control the risk. And there are 4 options available that we're going to look at as well. However you treat a risk is entirely up to yourself though. Again, based upon your industry or sector and the sensitive nature of the specific risk to your industry as well. Then finally, we'll look at reporting, how to report on the risk and how to avoid your risk being overlooked or deemed too complicated. So to begin with, what is 27001? For those of you who've not come across 27001, well, ISO 27001 formally specifies an information security management system, or ISMS, which is a suite of activities concerning the management of information risks called information security risks in the standard. Now, the ISMS is an overarching management framework through which the organization identifies, analyzes, and addresses its information security risks. The ISMS ensures that the security arrangements are fine-tuned to keep pace with changes to the security threats, the vulnerabilities, and also the business impacts, which is an important aspect in such a dynamic field and a key advantage of 27001's flexible risk-driven approach. Now, the standard covers all types of organizations, for example, commercial enterprises, government agencies, not-for-profits, all sizes, from micro businesses to huge multinationals, and also all industries or markets such as retail, banking, defence, healthcare, education, and government. So it's clearly a very, very wide brief. Now, 27001, as we said, it's an information security standard that helps companies come into compliance with international best practices. The standard covers 3 key components of data security: people, processes, and technology. Now, when steps are taken to safeguard data with these 3 components in mind, businesses are better equipped to protect information, mitigate risks, and also rectify procedures that are deemed ineffective. Now, as such, a growing consensus has emerged in the corporate sector that deems 27001 is the gold standard in best practice schemes. So by putting 27001 into effect, an organisation activates an ISMS that works within the business culture of the company in question. And the standard is regularly updated and enhanced. And these ongoing improvements allow the ISMS to stay abreast of changes both within and outside the company, all the while spotting and eliminating new risks. Now, It's designed to support the confidentiality, integrity, and availability of your information and help you maintain legal compliance. It also helps you protect your data from cybercrimes, misuse, fire, theft, and other threats. Having a certified ISMS in place will give your customers more confidence in your company, as well as improve their relationships with other stakeholders and also help you mitigate risks. So we can see there we've got the three key elements of how we should conduct risk assessments to assess the risk against the confidentiality, integrity, and availability of our information assets. So let's look at confidentiality then. So a common example of confidentiality would be an online transaction conducted over secure methods, such as the use of encryption, whereby information is protected across such things as HTTPS, secure certificates, SSL, things like that. As for the integrity, an example would be the trustworthiness of customer financial account information, such as bank accounts or personal information that are held by a bank for conducting daily operational transactions. And finally, availability. Well, this could pertain to a bank's customer-facing web service that hosts the online banking portal, for which some customers can access any time of the day. And we don't have to go too far to look at recent breaches with certain banks that have lost that availability. Some banks have been down for days, so we can see that it touches those elements as well. So as we said, we're going to look at information security risks and risk assessment. So here are some definitions. Now, according to ISO 27000, Information Technology Security Techniques ISMS Overview Vocabulary, a lovely document if you want to take up and read it. It does explain a lot of the things that are talked about within 27001, and kind of helps you understand what the standard means when it talks about certain elements. But we're going to look at two key elements there. We're going to look at risk assessment and risk treatment. So risk assessment is the overall process of risk identification, risk analysis, and risk evaluation. And risk treatment is the process to modify that risk. Now, the risk methodology. So coming up with a risk methodology. Now, this is your first step on the voyage through risk management. Now, you need to define rules on how you're going to perform the risk management, because you want your whole organization to do the same way. The biggest problem with risk assessment happens if different parts of the organization perform in a different way. Okay. Therefore, you need to define whether you want qualitative or quantitative risk assessments, which scales you will use for qualitative risk assessment, what will be the acceptable level of risk, etc. So this is your criteria. Okay. This is how we're going to do this. Then you need to adopt a scale. For example, this may be in monetary terms, single numbers, or even low, medium, or high. Now, we're going to talk about qualitative or quantitative risk assessments later in this presentation. Then you need to define what your appetite is. Determine your risk, and you need to then ascertain how important that risk is to your business, or how big of a risk that is to your business. And then finally, think about the asset scenario. So when performing a risk assessment, think about the items you have under your control and the potential situations that may arise which could cause a risk. And also, what's the threat or the vulnerability as well. Now, these are rules governing how you intend to identify risks, who you assign risk ownership to, how the risk affect the confidentiality, integrity, and availability information, and the method of calculating the estimated damage of each scenario and the likelihood of it occurring. So it's key that you get these things in place. So as we said, everyone knows how to conduct a risk assessment, and we come up with some comparable results. Identifying the risk can affect the confidentiality, integrity, and availability of information, and is the most time-consuming part of the risk assessment. Now, following an asset-based approach, for example, can help develop a list of information assets. It is a good place to start. But if you can find an existing list, most of the work is done for you. So basically, if you can find an asset list, let's say, that's a good place to start. But what you need to take into account is a lot of people think assets are just physical items, so a laptop, a PC, but they can be, data held in servers, in cloud backups, anything, and you need to ascertain what your information assets are. So as we've got there, we've got asset, threat, and vulnerability. So you can see asset can be infrastructure, people, the organization, the processes. The threat can be theft, malicious, a malfunction, and the vulnerability for those can be unattended device, disclosure, breach of policy, etc. We'll discuss this further in more detail in a second. Now, you've got to identify the threats and vulnerabilities that apply to each asset. For example, as we just said, if the threat is theft of mobile device, for example, then the vulnerability is lack of formal policy for mobile devices. After you've done this, you should assign an impact and likelihood value based on your risk criteria. Now, you could use severity instead of impact, or probability instead of likelihood. Again, however you want to do it is entirely up to you. There's no set rules for this. This is your risk assessment, okay? Once you know the rules, you can start finding out which potential problems could happen to you. And you need to list all your assets, then the threats and vulnerabilities related to those assets. Assess the impact and likelihood for each combination of asset, threat, vulnerability, and finally calculate the level of risk. Now, in my experience, companies are usually aware of about 30% of the risk before you do this exercise. So you'll probably find this exercise quite revealing. And when you finish, you'll start to appreciate the effort you've made. So we said we're going to look at some examples. So if we just take one example of an asset, a laptop. Now, you may have numerous threats with a number of vulnerabilities, as we can see on the screen. So a laptop may have, for example, two threats, a threat of it being stolen and a threat of malfunction. So each of those threats may have numerous different vulnerabilities. So there we can see that from the theft of the laptop, well, a vulnerability is, well, it may have been an unattended device, it may have been left in unsecure premises. But then if we look at malfunction, well, the vulnerability is very different. The vulnerability might be, well, poor maintenance or software not updated. So you can see very clearly that from one asset, the laptop, you've got numerous different threats, and then off the back of there, numerous different vulnerabilities. And obviously, this is just an example of kind of put together to demonstrate that. Don't just think that there's just two threats associated with a laptop. So when you've come up with your information risk assessment and risk asset assessment, you then need to think about how you're going to categorize the risks to those assets. Now, you need to weight risk against your predetermined levels of acceptable risk, i.e. risk appetite, and you need to determine which risks you need to address and which ones you can ignore. Now, this is a common example on the screen now, and you may have seen this from health and safety risk assessments, okay? So there's a tried and tested method there with health and safety risk assessments, which everyone may or may not have seen. So why invent the wheel, okay? And this is a more common example. I do see others, I see a 3x3 or even a 10x10, but the most common one I see is a 5x5. You need to make it fit your organization, okay? So here on the matrix, we can see we've got a 5x5 matrix with the impact on the side. So impact from 1 to 5, ranging from low, very low is 1 to very high is 5. And then across the bottom, we've got likelihood again. 1 is very low, up to 5, which is very high. So from here, you can determine the overall risk rating, whether it be high, medium, or low. So, example, if you were to take a risk which has a medium impact and a medium likelihood, you'd get a score of 9, which fits there into the medium level. So you can say that that risk has an overall risk rating of 9, for example. Again, this is just a very basic example of things I come across in everyday auditing and things I've come across myself during conducting risk assessments myself. So then you have to think about the criteria of the impact. So impact is usually measured in terms of confidentiality, integrity, and availability. Now, this may include financial, reputational, and regulatory impact. Also, information security and operational impacts too. Once you've analysed your risks, you need to evaluate them to establish where they fit in terms of your risk appetite. Only once you've done this can you decide the appropriate way to treat each risk. Now, this means you should be able to quickly identify your highest risks and create a prioritized list of which risks to address in which order. Now, it's particularly important to identify whether or not the risk falls within or outside your predetermined level of acceptable risk. Now, when risk owners say that they will accept a risk, for example, 9, let's say they've got a risk of 9, they must be prepared to accept a business situation, such as the loss of, let's say, £100,000 every year, rather than the less relevant impact of 3 or likelihood of 3. In practice, there's a link between impact and threat and vulnerability and likelihood. As similar threats tend to produce impacts on a business, and similar vulnerabilities produce similar likelihoods. Impact types could include such things as human, financial, legal, regulatory, reputational, and operational factors. Likelihood factors could include frequency of occurrence, previous occurrence, current levels of security control, size of attack group, and also the knowledge of the vulnerability. So we talked about the quantitative and qualitative risk assessments before, and I'll just explain them a bit more what we mean by them. So quantitative risk assessments and methodologies give quantitative estimates of risk, given the parameters defining them, and they're used predominantly in the financial sector, the chemical processing industry, and other areas. Now, in financial terms, quantitative risk assessments include a calculation of the single loss expectancy of a monetary value of an asset. So, for example, a common example of this risk is we've got a risk of the office flooding. Now, this organisation has said, well, the impact of that is the cost is £10,000. The likelihood of that happening, well, it happens every 2 years, okay? So there we've done a quick calculation. We said, well, the annual expected loss is £10,000. It happens every 2 years, so annually that's 0.5. So we've got a financial cost there of £5,000 annually. So that cost is worth £5,000 to that company. And that is what we mean by quantitative risk assessments. A qualitative risk assessment is a project management technique concerned with discovering the probability of a risk event occurring and the impact the risk will have if it does occur. Now, all risks have probability and impact. Probability is a likelihood that a risk event will occur, and impact is the significance of the consequences of that risk event. Assigning probability and impact to risk is a subjective exercise. Some of this subjectivity can be eliminated by developing rating scales that are agreed upon by the organisation. Generally speaking, an organisation must define impact and likelihood levels that are relevant to the business. Now, 27001 and another document called ISO 27005 do not state whether these levels should be quantitative or qualitative, high to low, 1 to 5, 1 to 100, or otherwise. What is important is that people understand the scoring in business terms. So what that means is, whichever way you think you can get the message across to people that this risk is a high risk and it's a danger to the business, whether that be declaring that this risk could cost the business £5,000 a year, or whether this risk is a high risk or a number 5, that's up to you. You've just got to be able to demonstrate that, and then also be able to spread that awareness throughout the company so that everyone in the organisation knows that's how we do risk assessments, and that's what a high risk means, and that's what £5,000 loss of company means. So we've done when we've established that, then we can make levels, our impact level. So we can start off, and again, this is entirely up to you how you do this. This is just a kind of crude example, but we get our impact level. So we might say, well, this is a minor impact. So almost every day business, this occurrence happens. Or we could say, well, it's a loss of between 0 to 1,000. Significant, so the risk is getting a bit greater now. We could say, well, this may force us to change some of our processes. Or we could say, yeah, risk between 1,000 to 10,000 pounds. Moving up to major, it's an acceptable risk. Might have to change organisationally. May cost us between 10,000 and 50,000 pounds. Again, moving up, so this risk is getting really kind of substantial now. So it's an intolerable risk. So and this could bring about significant organisational change, maybe some potential recovery afterwards as well. And again, we can see it will cost us upwards of £250,000. right the way up to a catastrophic risk, which is a potential closure of business, £250,000 plus cost. This is a risk that no one would like to see on their risk register, certainly not after risk treatment anyway. So, which leads us on to risk treatment, which was a good link. So we've got 4 options for risk treatment. We've got modify, transfer, avoid, and accept. So modify is applying security controls. Transfer the risk. We can transfer it to another party. So an insurance company by buying an insurance policy, for example. We can avoid the risk by stopping an activity that is too risky or doing it in a completely different fashion. So that's a change of process, as we spoke about. And finally, we can accept the risk. For instance, the cost of mitigating the risk would be higher than the damage caused itself. Yeah, if you've got a risk and the damage may be, well, it's going to cost us too much to change, or the risk of changing it might be too high. For example, something I've come across is in server rooms when we've got a network cabling issue. Now, the risk of moving the cables out to tie the network cabling area up is actually greater than just leaving them in situ as they are. Well, that's what you've done. If you've accepted that risk, that's fine, as long as it's documented somewhere and someone has actually signed off to say we accept this because of X, Y, and Z. That's fine. At least you've addressed the risk. Now, with these risk treatment options, this is where you need to get creative. How to decrease the risk for minimum investment. Now, it would be the easiest if your budget was unlimited. Okay, if we had an unlimited budget, we could throw money at everything and everything would be reduced. But it's never that. But that's never going to happen. And I must tell you that, unfortunately, your management is right. It is possible to achieve the same result with less money. You just need to figure out how. Okay, so we'll look at each option in a bit more detail. So the first one is treat. Now, treat or modify is a process used to ensure information risks are reduced to an acceptable level. Action should be in line with the level of risk posed to information assets, normally by adding strengthening security controls that will reduce likelihood of vulnerability. Now, Clause 6.1 of Annex A of the standard side, 2001, describes how an organisation can respond to risk with a risk treatment plan. An important part of this is choosing appropriate controls. Within Annex A of 27001, there are 114 controls in 14 clauses made up of 35 control categories. So we've got them on the screen there. So the first one, we'll go through these. I'll give you a brief overview as to what all these mean. Okay. So the first one we've got there is information security policies. Now, these are the controls and how the policies are written and reviewed. Okay. Many of you will have security policies in place already. A6 is the Organisation of Information Security. These are controls on how the responsibilities are assigned, and also the controls for mobile devices and teleworking are also in that control measure as well. A7 is quite a big subclause. It's around human resources security. So this covers controls prior to employment, during and after employment. So we're looking at things like screening and background checks and training and disciplinary processes and things like that. Okay. A8 is asset management, which these are controls related to inventory of assets and acceptable use. Also for information classification and also media handling too. A9 moves on to access control. Now, this is the controls for the access control policy, user access management for systems and application access control, and also user responsibilities. A10 talks about cryptography, and this is the controls related to encryption and key management. And then A11 is again another big section about physical and environmental security. These controls define secure areas, entry controls, protection against threats, equipment security, secure disposal, and also clear screen policy. The physical environmental security is one of the elements that when I'm auditing, a lot of people kind of look at me and say, Chris, what are you talking about that for? What are you talking about, maintenance of air cons or something like that for? Well, in that control measure, there are elements that talk about maintenance of equipment. So maintenance of equipment, which looks after information processing facilities, such as your servers, anything like that. So that's why sometimes when the auditor talks to you about physical security, that's where he or she is kind of going. down the A11 route. Next control is A12, which is operational security. Now, there's lots of controls related to management of IT production, change management, capacity management, malware backup logging, monitoring, installation, and vulnerabilities, all that good stuff. There's quite a big section there, quite an interesting section, predominantly based around the IT departments of the company as well. A13 is communication security, and these are controls related to network security, segregation of network services, and also transfer of information and messaging. A14 is systems acquisition, development and maintenance. So these controls define security requirements and security and development and support processes. A15 is supply relationships. This is controls on what to include in agreements and how to monitor the suppliers. A16 is information security incident management. So these are the controls for reporting events and weaknesses, defining responsibilities, response procedures, and also collection of evidence. This is quite an important control clause if you're looking for things that relate to, for example, GDPR. Okay, so we've all heard about the change in the GDPR or the data breach response time thanks to GDPR. A16 will help you kind of get around those reporting times, and it'll lead you down a road of coming up with a process to identify incidents and also report on them, which ties in quite nicely to the GDPR timelines. A17 is the information security aspects of business continuity management. So these are the controls requiring the planning of business continuity, the procedures, the verification and reviewing, and also IT redundancy. Finally, A18 is compliance. So this is controls requiring identification of applicable laws and regulations, intellectual property protection, personal data protection, and reviews of information security. So I've seen I'm going to answer all questions at the end, but there's a question that's just popped up, which I can answer now. The question was, how does GDPR feature within the 27001 standard? Well, right there, A18. So the compliance section wants you to identify applicable legislation and then detail how you show compliance to that. So that's one area where you have to kind of write down GDPR and then demonstrate how you comply to that. Okay. Now, Annex A of 27001 sets out 114 good practice security controls. The controls use the word should and are neither mandatory nor exhaustive. This means that organizations with differing risks will apply these controls at different levels of strengths. Now, although 27001 doesn't require you to use Annex A controls exclusively, you do have to check the controls you select from elsewhere against those in Annex A to ensure that each risk is appropriately mitigated. So, having selected your controls, you need to produce a statement of applicability, or SOA. Now, this is one of the most important ISO 27001 documents, and it should identify the controls you've selected to address the risks you identified, explain why you've selected them, state whether or not they've been implemented, and explain why any ISO 27001 Annex A controls have been omitted. Now, there's going to be at least 114 entries in the statement of applicability, one for each Annex A control, all of which will include extra information about each control and ideally link to relevant documentation about each control implementation. A risk assessment report can be very long, so the statement of applicability is a very useful document for everyday operational use. A simple demonstration that controls have been implemented and a useful link to the relevant policies, processes, any other documentation or systems that have been applied to treat each identified risk. Think of it as kind of like an index to your ISMS. Now, this document actually shows a security profile of your company based on the results of the risk treatment you need to list. Excuse me. You need to list all the controls you've implemented and why you've implemented them, and also how. And the document is also very important because as auditors, this is something which will it'll be used as a main guideline for the audit. Also, as well, because it will have detail about how you've implemented controls and also probably some of your weaknesses. You need to make this document one of the most secure documents you have in your organization. So moving on from modify and treat to transfer or share now. So This is achieved generally by insuring or outsourcing. Although you would typically still suffer the impact, you can share the risk with someone better able to manage it, as we said, like an insurance company, someone like that. It shifts parts of the risk to other organisations or contractually to business partners, for example, IT support services. However, an organisation, I'm going to make this clear, an organisation cannot transfer ownership of the risk. Okay, it's still your risk at the end of the day. The next one is terminate or avoid. Now, this is just ending the activity or circumstances causing a risk, for example, by not carrying out the risk or by moving it to a different location. Now, this occurs when there's no cost-effective action to reduce the risk. It may involve choosing an alternative activity which meets the business need. And then finally, we have tolerate or accept. Now, it's commonly an acceptance by management that the risk falls within their previously established risk acceptance criteria or via extraordinary decisions. It also means that no additional action is required other than what is already in place. Now, this should be documented and communicated to senior management. So when you've applied your risk treatment, you have to come up with a risk treatment plan. Or when you've decided what your risk treatment is, you need to create a risk treatment plan. Now, this is a step where you have to move from theory to practice, okay? Let's be frank, all up to now, this whole risk management job was purely theoretical, but now it's time to show some concrete results. Now, this is the purpose of the risk treatment plan, and to define exactly who is going to implement each control, in what time frame, with what budget, etc. Now, sometimes I prefer to call this document an implementation plan or action plan, but let's stick to the terminology used in 27001, okay, risk treatment plan. Once you've written this document, it's crucial you get your management approval, because it will take considerable time and effort and money to implement all these controls that you've planned, okay? And without their commitment, you won't get any of these. So it's vital that they sign off on this. Once you've done that, and once you've kind of implemented your treatment and you've stated how you're going to do that, you've got the sign off from the top management, and you've had a budget approval, that's it. You started your journey from not knowing how to set up your information security all the way to having a very clear picture of what you need to implement. Now, the point is, 27001 forces you to make this journey in a systematic way. Some people think that when they go through stage 1 and stage 2 audit and they get certified, that's it. That's the end of the journey. Well, that's couldn't be further from the truth. That is just the beginning. Okay, so it's not a. I always tell people it's not a destination; it's a journey, and it's a constant journey. So that's the end of the webinar. I hope it's been beneficial. We do like to kind of improve our webinars as we go along. So if there's anything in the webinar or anything that wasn't in the webinar that you would have liked to see in the webinar, anything we didn't touch on which you thought we could put in for the next time, please feel free to put it in the questions bar now. Send it in an email to nqawebinar.com. But we can only make these webinars better by knowing what it is that you would like to see in them. So please feel free for suggestions. So I'll take some questions now. So we've just had one in from Kelvin. When will it be possible to get a copy of the presentation? As soon as the presentation finishes, Kelvin, it gets saved, and the marketing team normally send it out the same day, if not the following day, or probably in this case Monday. So you'll have it within a few days or so. Just to reiterate about we had a question from Donald before about how does GDPR feature within the 27001 standard. Again, most standards nowadays ask you to show a level of compliance to applicable legislation. That's how 27001 covers legislation such as GDPR. But what you'll find is we've produced a excuse me, a blog recently, and it's a 27000 GDPR blog, which has got a bit of a mapping tool on there, and it shows you how GDPR maps across to how 27001 maps across to GDPR. So it shows you by doing certain things within 27001 that you become compliant with GDPR. If there's no more questions, I can't see any more coming through. If you do think of any more questions in the meantime, please feel free to email them in, and if we get enough, we'll put together a frequently asked questions blog, or indeed include it in the next blog. But I'd just like to thank you all for giving up your time and attending today, and I hope you all have a good weekend. Thanks. Goodbye.